Welcome to the Deep Dive.
Yeah.
Today we're diving headfirst into market outlooks for 2025.
Oh, 2025. Exciting times.
We've got reports from Amundi, Barclays,
Okay.
BlackRock,
Wow, the big ones?
Goldman Sachs, JPMorgan,
Yep.
and UBS.
All right, so we got a lot to cover.
We've extracted the most valuable insights so you don't have to.
Consider us your personal market analysts. We're cutting through the noise, highlighting what matters most for your investments, and helping you understand this global economic landscape.
We'll cover the big picture trends shaping the markets to specific opportunities in various asset classes, both traditional and alternative.
Right.
We'll even explore different regions and uncover those hidden gems that could really boost your portfolio, all in under 30 minutes.
Challenge accepted.
So let's start with the big picture. What are the overarching themes we're seeing across these reports?
Well, the resounding theme is change. Global economic power dynamics are shifting, driven by deglobalization, the energy transition, and the rapid advancement of technology, particularly AI. It's a time of great transformation, and investors need to be prepared for a dynamic ride.
Okay, fasten your seatbelts, everyone. Speaking of dynamic, what's the general consensus on global economic growth in 2025?
You know, despite all this uncertainty, almost all institutions are predicting continued global economic expansion in 2025.
Okay.
Though it'll probably be at a more moderate pace compared to recent years. Good news is inflation appears to be cooling,
Right.
and central banks are signaling further interest rate cuts.
That sounds like a potential tailwind for certain asset classes.
Exactly.
But you mentioned uncertainty.
Right.
What are some potential headwinds investors should be aware of?
Well, geopolitical risks remain a major concern. Trade wars, tariffs,
Yeah.
they continue to cast a shadow over the global economy, potentially disrupting supply chains, and impacting investor sentiment.
So, a bit of a mixed bag. Moderate growth with lingering geopolitical risks.
Yeah, I think that's fair to say.
What does this mean for investors?
Well, it really underscores the importance of diversification and being selective. Investors need to be strategic, in navigating these uncharted waters.
This is where our deep dive comes in handy.
Exactly.
Now let's get specific and break things down by asset class. First up, equities.
All right, equities.
Amundi highlights that while U.S. megacaps might be overvalued, opportunities are emerging elsewhere.
Interesting.
They see potential in Japan, Europe, particularly among small and mid-cap companies,
Yeah.
and even in specific sectors within the U.S. market beyond the usual tech giants.
So kind of looking beyond the big names.
So there's still potential for growth in equities, but investors might need to look beyond those familiar names and venture into new territories.
Yeah, broaden the horizon a bit.
What about emerging markets? Are they still on the radar?
Absolutely. Asia and emerging markets are expected to outperform developed markets. Amundi is particularly bullish on India and Indonesia,
Interesting.
citing their growing middle class and expanding consumer markets as long-term growth drivers.
It seems like there's a shift in global economic power happening right before our eyes. Now, I'm curious about China. They've been a major player in the global economy for years, but their growth seems to be slowing.
Right.
What's the outlook there?
China. Well, China is a bit of a wild card right now. While their growth is moderating, there is potential for stimulus measures to provide some support. Additionally, resolving their local government debt issues could be a positive catalyst.
Okay, so there's still some potential in China, but investors need to proceed with caution.
Yeah, I would say so, yeah. It's crucial to monitor their policy decisions and any potential fallout from trade wars, as these factors could significantly impact their economic trajectory.
China definitely requires a watchful eye. Okay, let's move on to fixed income. What's the word on the street for bonds in 2025?
Bonds. Barclays suggests that falling interest rates could make bonds more attractive, especially in Europe, where yields are low, but the growth outlook is more conservative.
Makes sense. Falling interest rates generally make existing bonds more valuable. But where can investors find yield in this low interest rate environment, especially with credit spreads being so tight right now?
That's a crucial question for fixed income investors. Alternative fixed income strategies might be the answer. For example, structured credit or securitized credit,
Okay.
which involve pooling together different types of debt. These could offer higher yield potential.
That sounds intriguing, but what are the risks associated with these alternative strategies?
Well, like all investments, they carry inherent risks. Investors need to be aware of the underlying assets in these structures and carefully assess the potential for defaults or losses. It's essential to conduct thorough due diligence before venturing into these more complex areas of the fixed income market.
Solid advice. Risk and reward always go hand in hand. Now, I'm excited to delve into alternatives and thematic opportunities.
Me too.
This is where things get really interesting. What are some of the emerging trends catching your eye?
AI, undeniably. It's a mega trend to watch.
Oh yeah.
It's poised to revolutionize countless industries, from healthcare and manufacturing to finance and beyond. It's not just a buzzword, it's a transformative force reshaping the world as we know it.
So, for investors looking to capitalize on the AI boom, where should they focus their attention?
Well, there are two main avenues. You have your established mega caps, already incorporating AI into their operations. And then you have your innovative private companies developing cutting-edge AI technologies. Both present unique opportunities and risks.
So the established players offer stability and proven track records, while the startups offer higher growth potential but also greater uncertainty. It's a classic dilemma for investors.
It really is. It all boils down to your risk tolerance and investment horizon. Are you comfortable with the potential volatility of early-stage companies? Or do you prefer the relative stability of established giants?
That's a great point. Now, let's not forget about the ongoing energy transition. BlackRock highlights clean energy, power infrastructure, and resource innovation as areas with long-term growth potential. It's not just about being environmentally conscious, it's about understanding where the world is headed and positioning yourself to benefit from these inevitable shifts. What are some specific opportunities within this space?
I think BlackRock is particularly bullish on renewable energy sources, like solar, wind power, as well as the companies involved in developing and manufacturing these technologies. They also see potential in energy storage solutions, which will be crucial as the world transitions to a more intermittent energy grid.
It sounds like a great opportunity for investors who are looking to align their portfolios with a sustainable future. But what about risks? Are there any challenges associated with investing in the energy transition?
Of course. The energy transition is a complex process, and there will be winners and losers along the way. Government policies, regulations can significantly impact the profitability of clean energy companies. And technological advancements can quickly render certain solutions obsolete.
So diversification and due diligence are crucial here as well. Investors need to carefully research the companies and technologies they're investing in. Spread their bets across multiple subsectors within the broader energy transition theme. Now let's talk about something a bit more tangible, real assets. Are there any opportunities for investors looking for more concrete investments?
Both JPMorgan and UBS highlight private market assets, like real estate, as potential sources of portfolio diversification and stable income. They offer uncorrelated returns, meaning they don't necessarily move in lockstep with public markets, which can be beneficial during periods of market volatility.
Real estate has been a roller coaster lately, soaring prices followed by cooling markets, and rising interest rates adding to the uncertainty. What's the outlook for 2025 and beyond?
It's true that the real estate market is cyclical. However, for long-term investors, real estate can be an excellent way to build wealth and generate passive income. The key is to be selective and focus on markets with strong underlying fundamentals.
So location still holds true.
Absolutely. And it's not just about owning a piece of property, it's about owning the right type of property in the right location.
Okay, so we've covered equities, fixed income, and even touched on alternatives like real estate. But there's one more alternative investment that JPMorgan highlights, and it's a curveball: sports investing.
Sports investing. It is an intriguing area. It's becoming more accessible and potentially lucrative. However, it's not without its challenges.
What kind of challenges are we talking about?
Well, for starters, declining viewership for traditional media and rising streaming costs are putting pressure on traditional revenue models in the sports industry. Investors need to carefully assess these trends and understand how they might impact the value of sports-related assets.
It sounds like investing in sports requires a deep understanding of the industry's dynamics and a willingness to embrace change. It's not just about owning a piece of your favorite team anymore.
Exactly. It's about understanding the business of sports and identifying opportunities where innovation and technology are driving growth.
Speaking of innovation, let's shift gears and talk about some key factors everyone needs to keep in mind as they navigate this exciting yet uncertain market landscape. The U.S. election has injected a hefty dose of both opportunity and volatility into the markets. What are the experts saying about its potential impact?
Well, the new administration's policies on tariffs, fiscal spending and regulation will have a significant impact on global economic dynamics and investor sentiment.
It's like everyone's waiting to see which way the wind will blow, right? How are these uncertainties impacting investor sentiment?
Investor sentiment is definitely cautious.
Yeah.
The direction the U.S. takes on key policy issues will have ripple effects across the globe.
This uncertainty adds another layer of complexity to an already intricate market landscape.
It really does. And speaking of things that make investors nervous, debt sustainability, especially in the U.S., is a major concern. Rising government debt levels and potential policy shifts could lead to higher interest rates and market turbulence.
It's a reminder that risk is always a part of the equation. What else should we be keeping an eye on?
Labor market dynamics and productivity growth are crucial. While the U.S. has seen a pleasant surprise in productivity lately, Europe is lagging behind. AI could potentially be a game changer for future productivity, but its adoption faces challenges related to data, energy, and regulation.
Lots of moving pieces there, and I'm sensing another potential risk factor brewing, am I right?
You are. Anti-establishment political movements are gaining traction globally, which could lead to increased volatility and policy uncertainty. Investors need to factor this into their risk assessments. It's not just about economic numbers, it's about understanding the political landscape as well.
Okay, that's a lot to take in. We've covered a ton of ground already, from the big picture trends to specific opportunities and risks in various asset classes. Before we move on, I think it's time to pause and reflect on what we've learned so far.
I agree. Let's recap the key takeaways before we dive deeper into some of these fascinating topics.
Sounds like a plan. We'll be right back after a short break to continue our exploration of the 2025 market outlook.
Looking forward to it.